Hi Vardhan, hello, good evening. Am I audible clearly? Am I audible? Good. Yes, CA Inter students, I welcome you all for live revision of CA Inter PGBP. Now, what are the sections covered under PGBP? Section 28 to 44, these are the sections covered. Charging section is section 28. Next, what is the method of accounting? Method of accounting is either cash basis or accrual basis as may be followed by the. So under PGBP, SSC can follow accrual basis or SSC also can follow cash basis. Except these sections, section 32, 35D, 35DDA, 43. For these four sections, cash basis is only applicable. Next. Charging section, you all know, like income from business or profession is taxable under PGBP. Profession includes vocation also. So whatever the income that is received from either business or profession, including vocation, such income is taxable under PGBP. Charging section, like there are 10 points in charging section. Charging section you can study on your own. Like charging section, in most of the times it is not being asked in the examination. So but some important points are there. Keyman insurance policy compensation, if it is received by employee, taxable under salaries. If it is received by employer, taxable under PGBP. If it is received by family members of employee, then it is taxable under income from other source. Okay. Non-compete fees, that is also important. If any non-compete fees is received, that is taxable under PGBP. Similarly, on conversion of stock in trade into capital asset. Whenever you convert stock in trade into capital asset, on date of conversion, whatever the fair market value is there, that fair market value will be considered as sales under the head PGBP. Are you able to understand? So, for example, let's say I am doing AC business. My main business is buying and selling of ACs. What I have done, whatever the AC that is there in my stock in trade, that AC I installed in my office. So whenever I install AC in my office, I am converting stock in trade into capital asset. On the date of conversion, whatever the fair market value is there, that will be considered as sales amount under the head PGBP. Are you able to understand? So these are important points. Remaining points you can study on your own. Next, section 30 to 37. These expenses are very important, which I will discuss with you right now. PGBP head is very vast. So easily, definitely one question will come in the examination. Easily you can expect 10 marks or more than 10 marks from PGBP. So as PGBP head is very vast, I will discuss PGBP in two parts. Today I will discuss, tomorrow also I will discuss PGBP. So in two parts I will finish PGBP. First, section 30, building expenses. Very simple. I am owner of this building. I am using this building for my business. What are all the expenses that I can claim as deduction? As a owner, I can claim depreciation on the building. Next, whatever the repairs that are done to the building are there, revenue repairs. If I have done capital repairs, it is not allowed as expenditure. That will be added to the cost of the asset. So whatever the revenue repairs that are done to the building are there, that are allowed as deduction. Similarly, I paid municipal taxes, property taxes, that is also allowed as deduction under PGBP. I paid fire insurance premium, that is also expenditure allowed as deduction under PGBP head. So as a owner, I can claim depreciation, I can claim revenue repairs, I can claim property taxes, I can claim fire insurance premium. All these expenses are which are of revenue in nature allowed as deduction under PGBP as per section 28. Are you able to understand? Next, if I am the tenant of the building, what are all the expenses that I can claim? Let's say I took one flat on rent. In that flat, I am doing my practice. I am doing my CA practice. Now, with regard to that flat, I will pay rent. Rent is a expenditure, business expenditure, that is allowed as deduction. Next, with regard to that flat, if I incur any revenue repairs, that is also allowed as deduction. Now, with regard to that flat, if I pay property taxes, that is also allowed as deduction to the tenant. If I pay any fire insurance premium, that is also allowed as deduction. The only difference is in case of owner, he will claim depreciation. In case of tenant, he will pay rent. He will claim rent as deduction. Are you able to understand? That is the difference. Students, always remember depreciation, rent. Both expenses are not allowed as deduction. Either depreciation is allowed or rent expenditure is allowed. Out of two expenses, any one of the expenses is only allowed as deduction. Are you able to understand? Sir, for example, I took one flat on rent. I am using that flat partly for, like, I am a bachelor. In one flat, one room I am staying, in another room I am doing recording. That means half of the flat is used for personal purpose, half of the flat is used for business purpose. Then whatever the portion of the flat that is used for business purpose is there, only for that portion, whatever the expenditure is there, only that expenditure is treated as business expenditure and it is allowed as deduction. Are you able to understand? Same expenses of plant and machinery and furniture. If I am, let's say, I purchased a power generator. With regard to power generator, I can claim depreciation. Are you able to understand? Next, with regard to power generator, if I incur any repairs and maintenance, if it is revenue in nature, I can claim as deduction. If I pay any fire insurance premium, that is also allowed as deduction. So, with regard to plant and machinery or furniture, owner can claim depreciation, he can claim revenue repairs, he can claim fire insurance premium. Tenant can claim rent as deduction. Let's say I took power generator on rent. Every day I need to pay rent. Whatever the rent paid for hiring power generator, that is allowed as deduction. Next, as a tenant, if I incur any revenue repairs, that is also allowed as deduction. If I pay any fire insurance premium, that is also allowed as deduction. Section 32, depreciation, I will discuss with you. Depreciation is also very important. I hope you are all having booster material with you. Are you having booster material? If you are not having booster material, you can go to my website www.phoenixbyuma.com. In that website, there is one tab, free resources. Under free resources tab, I have provided booster material at free of cost for you. You can download booster material and you can listen to my lecture. Okay. Now, shall we discuss the concept of depreciation? Yes. See, as per accounts, depreciation is calculated for each asset individually, but as per income tax, depreciation is calculated for a group of assets, which is also called as block. So under income tax, we will calculate depreciation on block wise. We do not calculate depreciation for each asset individually. Under accounts, there are various methods to calculate depreciation, SLM, WDV, machine hours method. But under income tax, there is only one method to calculate depreciation, which is written down value method, except in case of power sector undertakings. Power sector undertakings, they have an option. Either they can follow SLM or they can follow WDV. Okay. To claim depreciation on any asset, two conditions are required to be satisfied. Assessee shall be the owner of the asset and assessee shall use the asset for his business purpose. He shall use the asset for the purpose of business. Okay. So assessee should be the owner. Only owner of the asset can claim depreciation. of the asset cannot claim depreciation. Second condition, let's say I purchased one car. I am using car for my personal purpose. If I use car for my personal purpose, how can it be allowed as business expenditure? No. Car also should be used for business purpose. Only if car is used for business purpose, then only depreciation is allowed as business expenditure under section 32. So two conditions, like SSE should be the owner of the asset, SSE shall use the asset for his business purpose. Only if these two conditions are satisfied, then only depreciation is allowed as expenditure. Otherwise, depreciation is not allowed as expenditure. Condition 1 is there na, SSE should be the owner of the asset. For this condition, whatever this condition is there, owner of the asset, for this condition, there are 4 exceptions. What are those 4 exceptions? First, in case of hire purchase. See, generally in case of hire purchase, ownership will be transferred after payment of last installment. Now, even though ownership is transferred after payment of last installment, still SSE can start claiming depreciation from first year onwards. Are you able to understand? So, that is the exception. Second exception, leased asset. On leased asset, if you incur any capital expenditure, even though you are not the owner of the leased asset, still whatever the capital expenditure that you have incurred, on that capital expenditure you can start claiming depreciation. I took one room on rent. Okay, rent is 15,000 rupees per month. I modified the room. I am recording now, so I have done the studio setup. For studio setup, I have spent 1,40,000 rupees. Now 1,40,000 setup done for this room, it is capital expenditure. But whether I incurred capital expenditure on my own property? No, I incurred capital expenditure on leased asset. Even though I incur capital expenditure on leased asset, whatever the capital expenditure is there, on that capital expenditure I can claim depreciation even though the flat is rented flat. Are you able to understand? Next, third case, co-ownership. Let's say I am and my friend who is also in practice, we both together we purchased one Innova car. I contributed 20 lakhs, my friend contributed 20 lakhs. Now I am not the single owner of the car. Okay, my friend and me, we are co-owners of the car. Even though I am the co-owner, sufficient, whatever the amount that I have contributed, for that amount I can start claiming depreciation. Are you able to understand? Purchase covered under section 53A of Transfer of Property Act. See, there are 3 conditions. There should be agreement between seller and buyer. Buyer has paid the consideration, or buyer is ready to pay the consideration, or buyer has taken the possession of the property. If all these 3 conditions are satisfied, then buyer, okay, buyer will be considered as deemed owner of the property and buyer can start claiming depreciation. See, even though legally registration is not done, still buyer will be treated as deemed owner of the building. Are you able to understand? So these 4 are the exceptions to the first condition. SSE should be the owner. Next, there is no depreciation on land. Land is not a depreciable asset, so you cannot calculate depreciation on land. Next point, usage can be either active usage or passive usage. Passive usage means what? You do not use actively, you will keep the asset ready for use. Even the asset is ready for use, sufficient, you can claim depreciation on that asset. Are you able to understand? Reduced depreciation. Generally, for the purpose of calculating depreciation under Income Tax Act, what is relevant is not date of purchase. What is relevant is date of put to use. So depreciation is not calculated from date of purchase. Depreciation is calculated from date of put to use. If asset is put to use for greater than or equal to 180 days, we will calculate full rate of depreciation. If asset is put to use for less than 180 days, then we will calculate half rate of depreciation. Are you able to understand? So we need to see, if asset is not put to use at all, then we are not going to calculate depreciation. So under income tax, we do not calculate depreciation on time basis. Okay, for number of days asset is used, we do not calculate proportionate depreciation. What we will calculate, if asset is put to use for greater than or equal to 180 days, we will calculate full rate of depreciation. If asset is put to use for less than 180 days, we will calculate half rate of depreciation. Okay. In first year, asset is not put to use, but it is put to use in the second year. In second year, even though it is put to use for less than 180 days, still we need to calculate full rate of depreciation. That means half rate of depreciation concept is applicable only in the year of purchase. In the year of purchase, let's say first year, put to use greater than or equal to 180 days, full rate. First year, put to use less than 180 days, then half rate. Second year, put to use greater than or equal to 180 days, full rate. Second year, put to use less than 180 days, then half rate. That means what? In second year, even though asset is put to use for less than 180 days, we will calculate full rate of depreciation. Okay. So from second year onwards, even the asset is put to use for less than 180 days, we will calculate full rate of depreciation. Now, all assets, depreciable assets are classified into 4 categories. Okay. First one is building. Second one is plant and machinery, furniture, intangible assets. Okay. Now, building. What is the rate of depreciation applicable for building? If it is the residential building, rate of depreciation is 5%. Okay, mainly used for residential purpose. Rate of depreciation 5%, except hotels. Hotels, even though customers use for residential purpose, from owner point of view, it is commercial use only. So on hotel buildings, we will apply 10% rate of depreciation. Next, if hotels are used for, like if any building is used for commercial purpose, for doing business or for doing profession, then on that building rate of depreciation applicable is 10%. Okay, purely temporary erections. Purely temporary erections, what? Let's say wooden building is constructed. It is temporary structure. On wooden building, the rate of depreciation applicable is 40%. Very simple. Residential building 10%, commercial building, sorry, residential building 5%, commercial building 10%, hotels 10%, temporary structures 40%. Sir, what about additional depreciation? I will discuss with you. Additional depreciation concept is also there. Okay, have patience. Next, furniture. Rate of depreciation applicable for furniture is 10%. Very simple. Furniture rate of depreciation 10%. Goodwill rate of depreciation, sorry, intangible assets rate of depreciation is 25%. Nowadays, there is no depreciation calculated on goodwill. So if you see land, if you see goodwill, these two, on these two assets, you should not calculate depreciation. Are you able to understand? Furniture rate of depreciation 10%. Intangible assets, trademarks, copyrights, patents, know-how, on all these rate of depreciation is 25%. Next, plant and machinery. Very simple. Aeroplanes, rate of depreciation 40%. Ships, rate of depreciation 20%. Next, motor vehicles. If motor vehicles are used in hire business, then rate of depreciation is 30%. If motor vehicles are used other than in hire business, then rate of depreciation is 15%. Next, molds. You know molds, right? Like using mold, we can create n number of assets. On molds, rate of depreciation applicable is 30%. Next, air pollution control equipment, life-saving medical equipment, rate of depreciation is 40%. Next, books. On books also rate of depreciation is 40%. Next, oil wells rate of depreciation 40%. Windmills, if they are installed before 1st April 2014, rate of depreciation 15%. If they are installed on or after 1st April 2014, rate of depreciation is 40%. Sir, if any plant and machinery is there for which rate of depreciation is not specified, then for all residual plant and machinery, rate of depreciation is 15%. On computer, iPad, and all these things, rate of depreciation is 40%. Next, if you purchase any software, let's say I purchase a Tally software or Winman software, on that also rate of depreciation is 40%. Very, very important. If I purchase motor vehicle which runs by petrol or diesel, rate of depreciation 15%. if I use that vehicle in hire business, rate of depreciation 30%. But if I purchase electric vehicle, na, very, very important, I purchased electric car or electric bike, rate of depreciation is 40%. Are you able to understand? On e-vehicle, rate of depreciation is 40%. So did you understand, Saket? Now, computation of written down value of the block. Normally, how do we calculate? We will take opening written down value. To opening written down value, we will add additions. Additions are classified into two types: put to use greater than or equal to 180 days, put to use less than 180 days. After adding additions, then we will reduce assets sold. Whatever the assets sold are there, we will reduce sale value of the assets. So whatever sale value of assets, very important. Whenever any asset is sold, don't reduce book value, don't reduce written down value. Whenever any asset is sold, then from the block, what you need to reduce is sale value. Whatever the money that you have received on sale of that asset, that needs to be reduced. Sale value of asset, very, very important. Whenever you sell any asset, what you need to reduce is sale value. After reducing sale value, you are going to arrive at written down value for depreciation. Whatever written down value for depreciation is there, on that you are going to calculate depreciation. So whatever the depreciation is that you have reduced is there, then first you will reduce depreciation, then you will also reduce additional depreciation, normal depreciation as well as additional depreciation. After reducing normal depreciation and additional depreciation, you are going to arrive at closing written down value of the block. Normal depreciation, I have already explained to you how to calculate. First year, asset put to use for greater than or equal to 180 days, you will calculate full rate. First year, asset put to use for less than 180 days, you will calculate half rate of depreciation. From second year onwards, if asset is put to use for greater than or equal to 180 days or less than 180 days, you will calculate full rate of depreciation, normal rate of depreciation. Next, additional depreciation. That is important. I will discuss with you additional depreciation. Very simple. Additional depreciation is available only for two entities: those who are engaged in manufacturing business, those who are engaged in those who are power sector undertakings, those who are engaged in the business of, you know, generation, transmission or distribution of power. They are also called as power sector undertakings. See, I am a CA in practice. I am into service oriented business. Can I claim additional depreciation? I cannot claim additional depreciation. So I am into trading business. Can I claim additional depreciation? No. Only if I am engaged in manufacturing business or if I am engaged in the business of generation, transmission or distribution of power. Only for these two businesses I can claim additional depreciation. Are you able to understand? Next, see, there are four types of blocks. Building. On building, can I claim additional depreciation? No. On intangible assets, can I claim additional depreciation? No. On furniture, can I claim additional depreciation? No. Only on plant and machinery, I can claim additional depreciation. Sir, I purchased second-hand plant and machinery. Can I claim additional depreciation? No. Only on new plant and machinery, I can claim additional depreciation. Are you able to understand? Now, so I can claim additional depreciation only on new plant and machinery. Then only for new plant and machinery additional depreciation is available. Next, sir, I purchased a new plant and machinery, but I am using that new plant and machinery in corporate office. Can I claim additional depreciation? No. If you use new plant and machinery in administrative block, then additional depreciation is not available. Or new plant and machinery is used in residential accommodation, whether additional depreciation is available? No, additional depreciation is not available. Very in simple terms, only if you purchase new plant and machinery, and if that new plant and machinery is used in manufacturing area, then only you can claim additional depreciation. Are you able to understand? You purchased the trucks, motor vehicles, even though they are plant and machinery, even though they are new plant and machinery, even though you are into manufacturing business, still you cannot claim additional depreciation. Additional depreciation is available only if you purchase new plant and machinery, and such new plant and machinery is used in manufacturing area, then only additional depreciation benefit is available. Are you able to understand? Uh, if you are paying taxes under section 115 BAC default tax regime, additional depreciation benefit is not available. That means additional depreciation benefit is available only if you are paying taxes under optional tax rate. Are you able to understand? How to determine actual cost of the asset? You already know, whenever you purchase any asset, additions are there now. How to calculate value of additions? Whenever you purchase any asset, whatever the purchase cost is there, to purchase cost you will add incidental expenses. I purchased one manufacturing machinery from Mumbai. Okay, so I need to bring that machinery to Hyderabad. So purchase cost is 1 crore rupees. Whatever the transportation expenses are there, whatever the insurance charges are there, whatever the loading and unloading charges are there, whatever the trial run charges are there, all these expenses are to be added to the cost of the machinery till the asset is put to use. Okay, till the asset is put to use, whatever the expenses incurred, all those expenses will be added to the cost of the asset. Are you able to understand? Sir, please give a depreciation calculation example with additional depreciation. Saket, with regard to additional depreciation, I have solved this question. Whatever the revision that I am doing, whatever the class that I am teaching right now, it is revision class. In revision class, I am brushing up the concepts of PGBP. If you need a practical example with regard to calculation of additional depreciation, I have done booster series. Okay, in booster series, I have explained example relating to additional depreciation also. So depreciation 3 hours concept is there. Don't worry, you need not listen to 3 hours. I have given timestamps. Okay, in those timestamps, select additional depreciation. Hardly 15 to 20 minutes concept will be there. Then I have also solved one problem. Listen to those 20 minutes. You will get clarity about additional depreciation problem also. Okay. Next, see, whenever I purchase any asset, purchase cost plus incidental expenses till the time it is put to use. All those incidental expenses will be added to the cost of the asset. Next, if I receive any subsidy from the government or subsidy from third party, subsidy amount is to be reduced while calculating the cost of the asset. Are you able to understand? Similarly, like trial run was done. After doing trial run, I got finished good. I sold that finished good. Whatever the income received from sale of trial run products are there, that income is also to be reduced while calculating the cost of the asset. Are you able to understand? Next, whenever you are purchasing any asset, you should make payment by way of bank transaction. If value of asset is up to 10,000 rupees, you can make payment in cash. If value of asset is more than 10,000 rupees, then per person per day, you should make bank payment for more than 10,000 rupees expenditure. Are you able to understand? So like mandatorily, you should make payment by way of bank transaction if amount of expenditure is more than 10,000 rupees when you are purchasing the asset or when you are incurring the incidental expenses. Are you able to understand? So there are different cases to take to consider cost of the asset. For example, there was amalgamation. In amalgamation, amalgamated company received the asset from amalgamating company. In books of amalgamated company, cost of asset is equal to written down value in the books of amalgamating company. Next, demerger happened. assets transferred from demerged company to resulting company. In the books of resulting company, cost of the asset is equal to written down value in the books of demerged company. Are you able to understand? Next. Like there is stock in trade into capital asset. Whenever stock in trade got converted into capital asset, then cost of asset is equal to fair market value on date of conversion. That will be treated as cost of asset. Next, when any asset is acquired by way of gift or inheritance, written down value to the previous owner. For example, let's say I received one asset as a gift from my friend who is also a chartered accountant in practice. So in my books, cost of asset is equal to written down value to the previous owner. So whatever my friend's written down value is there in his books of accounts, that will be treated as cost in my books of accounts. So there are four cases: transfer of asset from holding company to 100% subsidiary company, 100% subsidiary to holding company, transfer of assets from amalgamating to amalgamated company, transfer of assets from demerged company to resulting company. In all these four cases, cost of asset is equal to written down value in books of previous owner. Okay, books of previous owner. Next. If any asset is used for specified business, section 35 AD, then if that asset is transferred to normal business, cost of acquisition is equal to 0, because already in specified business you would have claimed 100% of the deduction. Sir, it is also a provision that transporters can make till 35,000 in cash. Saket, for transporters, you can make payment up to 35,000. That is as per 40A3. Okay. But whenever you are purchasing the asset, even to transporter also, the limit applicable is 10,000 rupees. Because see, cost of asset is determined as per section 43(1). Section 43(1) specifies only one limit, which is 10,000 rupees. Are you able to understand? So whenever you are purchasing the asset, at the time of purchase of asset, if you make any payment to transporter, then 35,000 limit is not applicable. Then also 10,000 rupees limit is only applicable. Are you able to understand? However, for revenue expenses, section 30 to 37, for revenue expenses, section 40A3 is applicable. For revenue expenses, if you are making payment for transporter, up to 35,000 limit is applicable. Very, very important. Many students will make mistake here. Are you able to understand? So I hope you understood this point. So whenever you are purchasing the asset, only one limit, 10,000. Whenever you are incurring revenue expenditure, two limits, 10,000 and 35,000. Okay. Next, asset brought into India by a non-resident. Whenever non-resident brings any asset to India, then cost of acquisition is equal to original purchase cost minus for how many years he has used it for personal purpose. We should assume he used it for business purpose. We should reduce notional depreciation. Balance written down value will be considered as cost of additions. Sundar Pichai purchased one asset in 2023. Okay, in 2024 he started business. For 1 year he used the asset for personal purpose. In 2024 he brought the asset into business. Now in 2024, cost of asset is equal to original cost minus depreciation for 23-24. Are you able to understand? Even though he used it for personal purpose, we will calculate notional depreciation. We will reduce notional depreciation. Whatever the balance written down value is there, that will be considered as cost of addition. Are you able to understand? Like whenever you receive subsidy for two or more assets, then subsidy amount is to be allocated proportionately to each asset based on its value. Okay, let's say uh, A cost is 10 lakhs, B cost is 30 lakhs. Okay, now I received subsidy. Subsidy amount is 9 lakh rupees. How much is subsidy? 9 lakhs. 9 lakhs I have to apportion proportionately. Are you able to understand? 9 lakh into 1 by 4. How much? 2,25,000. This is the subsidy. 9 lakh into 3 by 4, 6,75,000. So whenever you receive subsidy uh, on a composite basis for two or more assets together, then whatever the subsidy amount is there, that is to be reduced from each asset on a proportionate basis. Next, capital gains in case of depreciable assets. See, there is written down value of the block now. We will calculate opening written down value. Let's say 10 assets are there. Their value is 8 lakhs. Let's say there are additions. 2 assets, 1 lakh, 9 lakh, total assets 12. Let's say we sold assets, sale value of assets. Let's say we sold 9 assets, we sold them for 8,50,000 rupees. Now, how many balance assets are there? 3 assets are there, their value is 50,000. The point is, only when there are assets in the block and block is having positive value, when these two conditions are satisfied, then only we will calculate depreciation. Otherwise, depreciation will not be calculated here. So, to calculate depreciation, two conditions are there. Condition 1, there should be some assets in the block. Second condition, whatever the block is there, that block shall have positive value. Whenever these two conditions are satisfied, then only we will calculate depreciation. Otherwise, we do not calculate depreciation. Are you able to understand? So, simply we can tell assets positive value. If there are assets in the block and block is having positive value, then we will calculate depreciation. If there are no assets in the block, but block is having positive value, then can we calculate depreciation? No, only when both conditions are satisfied, then only we can calculate depreciation. In this case, assets are not there, but block is having positive value. Think logically, if there are no assets in the block, still you calculate depreciation, you are unsound mind, correct? So, if there are no assets in the block, in that place, you will not calculate depreciation, you will calculate capital gains. Are you able to understand? If there are assets in the block, but block is not having positive value, then also you will not calculate depreciation, then also you will calculate cap. If there are no assets in the block, and if block is not having positive value, then also you will not calculate depreciation, then also you will calculate. Are you able to understand? So this is the concept. Very simple. Section 32. Section 32 speaks about depreciation. Section 50, it speaks about capital gains in case of depreciable assets. Section 32, Section 50, both are mutually exclusive. If you calculate depreciation, you cannot calculate capital gains. Whenever you do not calculate depreciation, then you are going to calculate capital gains. Are you able to understand? See, these four cases along with examples I have discussed already. What is to be taken as sale value? Uh, sale value. What is to be taken as full value of consideration? Full value of consideration is equal to sale value of asset. Then what is to be taken as cost of acquisition? Written down value of block will be taken as cost of acquisition. You will reduce written down value, thereby you will get short-term capital gain or short-term capital loss. That means what? Depreciable assets always treated as short-term capital assets. That's why in case of depreciable assets, short-term capital gain or short-term capital loss will arise. Are you able to understand? Next, apportionment of depreciation. Sir, what do you mean by apportionment of depreciation? I will tell you. Let's say if demerger, amalgamation, conversion of sole proprietorship into company or conversion of sole proprietorship into partnership firm or LLP, whatever these conversions are there now, if these conversions happen on 1st April of previous year, no problem at all. Entire depreciation will be allotted to successor, new person. But if conversion takes place in the middle of the year, let's say Uma Limited got converted into Uma LLP. This conversion happened on 1st November 2024. So whenever conversion happens in the middle of the year, then we will assume a single entity. We will calculate total depreciation. Whatever total depreciation is there, this total depreciation will be allotted to preceding entity and new entity based on number of days of usage of asset. Based on number of days of usage of asset. Based on that, we are going to calculate depreciation and we will apportion the depreciation among preceding entity and a new entity. Very simple conversions. Like amalgamation, assets transferred from amalgamating to amalgamated, demerger, assets transferred from demerger to resulting, conversion of sole proprietorship into company, conversion of private limited company into LLP. All these conversions, if they happen in the middle of the year, then assume asset is used by single entity, calculate depreciation for whole year. Whatever the depreciation for whole year is there, that is to be apportioned between predecessor and successor based on number of days of put to use of such asset. Are you able to understand? Unabsorbed depreciation. Sir, what do you mean by unabsorbed depreciation? See, in current year, we will calculate profit. For example, in current year, there is net loss. We did not claim depreciation expenditure. So if there is no profit to set off depreciation, or if existing profits are not sufficient to set off depreciation, then whatever the depreciation that could not be set off is there, that depreciation we call as unabsorbed depreciation. Are you able to understand? Now, sir, what is tax treatment for unabsorbed depreciation? Unabsorbed depreciation, we will do intra-head set off. That means if there is any other business income, we will set off against. And unabsorbed depreciation, then we will do inter-head set off. We will set off unabsorbed depreciation against other heads of income other than salary, other than section 115 BB and 115 BBJ, winning from lottery betting. Against that income, you cannot set off unabsorbed depreciation. So simple, unabsorbed depreciation, current year, you will set off against other business income. After setting off against other business income, still unabsorbed depreciation is there. You will set off against other heads of income other than salaries. You cannot set off against income from salary. You cannot set off against section 115 BB, BBJ income. Are you able to understand? Sir, after doing set off against other heads also, still some unabsorbed depreciation is left, balance. Whatever the balance unabsorbed depreciation left is there, that will be carried forward to next year. Okay, and in next year, that balance unabsorbed depreciation will be set off. Next year, will you set off this brought forward unabsorbed depreciation first? No. In next year depreciation will be there now. So against next year profits, first you will set off next year depreciation, next you will set off brought forward losses, then only you will set off brought forward unabsorbed depreciation. That means brought forward unabsorbed depreciation priority is third priority. So next year net profits came. Against those net profits, first you will set off next year depreciation, second you will set off brought forward losses, third you will set off brought forward unabsorbed depreciation. Are you able to understand? I hope, Saket, you are following. Now, next, if any asset is used partly for business purpose and partly for personal purpose. Then what will we do? Whatever the depreciation that is there for business purpose is there, only the depreciation is allowed as deduction. So if any asset is partly used for business and partly for personal purpose, then proportionate usage made for business will only be allowed as depreciation deduction. The depreciation deduction allowed above will only be reduced from depreciable value of the block. See, car is there. I have given example. 30% used for business, 70% used for personal purpose. Then we will calculate depreciation on car. On depreciation of car, 70% is 70% of depreciation disallowed. Only 30% of depreciation is allowed as expenditure in P&L account, and only 30% of depreciation will be reduced from written down value of the block. If any asset is used to earn composite income, you know, right? Rubber, tea, coffee. If any asset is like income from rubber business, 65-35 ratio. Income from tea business, ratio 60-40. Income from coffee business, okay. Four things are there: grown, cured, roasted, grounded. If four activities are performed, ratio is 75-25. Ratio is 60-40. Only two activities, growing and curing, was done. Ratio is 75:25. In that ratio, you will divide the income as agricultural income and business income. Highest percentage is agricultural income, lowest percentage is business income. Correct? Now, whenever any asset is used for earning composite income, then on that asset you will calculate depreciation, and total depreciation is allowed as expenditure, because you will claim total expenditure. Whatever the net profit is there, na ultimate net profit you will divide as 60:40. That's why total depreciation is allowed as deduction. So if asset is used to earn composite income, depreciation shall be computed as if the asset is completely used for business. So total depreciation will be reduced. The depreciation so computed shall be deemed to have been actually allowed to the asset. Next, power sector undertakings. Power sector undertakings, they have two options. If they want to follow SLM, they can follow SLM. If they want to follow written down value method, they can follow written down value method. But if they follow straight line method of depreciation, then they need to calculate depreciation asset wise. But if they follow written down value method of depreciation, they need to calculate depreciation block wise. So in the year in which power sector undertaking or power generating unit was started, in that year decision has to be taken either to follow SLM or written down value. So whatever the decision that they take, the same decision is applicable till the uh, till the business is closed. Are you able to understand? Let's say I started power sector undertaking in 24-25. In 24-25, I will file my income tax return. Now, there will be due date for filing ITR. Before that due date only, I have to take decision. Are you able to understand? Either to follow SLM or written down value method. If I follow SLM, I need to calculate depreciation for each asset individually. If I follow written down value, I need to calculate depreciation for group of assets, which is also called as block. Now, capital gains in case of assets sold by power sector undertaking. Assets sold by power sector undertaking following straight line method of depreciation. Following straight line method of depreciation. Very simple, I will explain. Let's say written down value of asset is 8 lakhs. This asset is sold for 6 lakhs. There is loss now. Loss 2 lakhs is there. This loss 2 lakhs is called as terminal depreciation, and this terminal depreciation will be debited to P&L account. It was sold for 10 lakhs. Let's say cost of asset is 11 lakhs. In current year written down value is 8 lakhs. Okay, it is sold for 10 lakh rupees. Now there is surplus now, because written down value is only 8 lakhs. It was sold for 10 lakhs, or let's say it was sold for 9.5 lakhs. So how much is surplus? 1.5 lakhs. This will be credited to P&L account. Next, it was sold for 11 lakh 70,000. Now is there profit or loss? Book value is, written down value is 8 lakhs. It was sold for 11 lakh 70,000. How much is surplus? 11 lakh 70,000 minus 8 lakh. 3 lakh 70,000 is surplus. Out of 3 lakh 70,000, whatever the depreciation claimed earlier is there. How much is the depreciation claimed earlier? 3 lakhs. So to the extent of 3 lakhs, it will be credited to P&L account. Next, balance 70,000 is there. Na? This 70,000 will be considered as. Are you able to understand? So this is all about initial concept and depreciation part. So today I am exhausted. There is part 2 now. Tomorrow we will discuss we will revise remaining provisions of